Your bank account isn't really yours, not in the way you think. Your name glows at the top. The numbers line up like obedient soldiers, and the app never argues when you swipe. But beneath that polished glass lies a colder truth. Your balance is not a box of cash with your name on it. It's a promise, a claim, an IOU from a bank that owes you until the day it can't. And in a storm, promises can turn to mist. That's the hidden blueprint of modern money, a world built not on metal and ink, but on contracts, ledgers, and trust. It works flawlessly, right up until the moment it doesn't. Today, we walk behind the vault door and into the plumbing of the financial world to see how your money is created, where it truly lives, who controls it when weather turns, and why the fine print matters most when it's hardest to read. We'll move from goldsmiths and handwritten receipts to push notifications and overnight runs, across panics, rescues, and rewrites of the rules. By the end, your balance won't look like a pile of dollars. It will sound like what it has always been, a story you tell with your trust. Centuries ago, money had weight. It clinked and scraped and left your shoulder sore on the walk home. Gold and silver slept behind the thickest doors in town, watched by men with keys and guns. But people grew tired of hauling treasure, so the watchers began issuing paper receipts, promises to pay on demand. Not everyone came back at once. Most days the receipts simply changed hands. That's when the quiet alchemy began. The receipt became money, and money became a promise. That small shift grew into banking as we know it. In 1694, to fund wars and steady commerce, the Bank of England took its place at the center of a growing web of credit. London's clearinghouses let banks settle their scores with slips and ledgers instead of carts and coins. Banks realized they could keep a fraction in reserve and lend the rest because most people wouldn't come calling all at once. It was a brilliant trick of timing and trust. Efficient, energetic, and fragile. In 19th century America, fragility was a way of life. A patchwork of wildcat banks printed notes that might be worth $1 here and 80 cents a few towns over, depending on how far you stood from the source. The country raced forward, rails, factories, fortunes, while panics in 1837, 1857, 1873, and 1893 sent ordinary people sprinting for the teller's window. Lines formed, doors shut, and promises met their limits. Growth came packaged with dread. Bank money flowed easily in fair weather and froze when the sky darkened. Then came 1907, a year that turned whispers into shouts. A failed stock scheme triggered withdrawals that rippled outward, and the Knickerbocker Trust in New York crumpled under the weight of fear. With no central bank to play lifeguard, J.P. Morgan locked bankers in his library and forced rescue after rescue, a one-man emergency room for American finance. Clearinghouse certificates stood in for cash. Mergers were hammered together like bridges in a storm, and the bleeding slowed. Out of that chaos came a realization. The system needed a permanent backstop. The Federal Reserve arrived in 1913 to give the banking machine a heart that could beat harder in a crisis. But even a new heart couldn't stop the Great Depression's crash. By 1933, thousands of banks had failed and the nation's faith had fractured. Roosevelt called a bank holiday, shutters down nationwide, to halt the panic. In the aftermath came a new deal with the public, federal deposit insurance through the FDIC, and a wall between everyday banking and Wall Street's wagers. A thin sheet of paper had become a thicker promise. After the war, the world stitched itself to a new anchor. At Bretton Woods, major currencies tied themselves to the dollar, and the dollar promised foreign governments a fixed price in gold. This outside money, gold, sat at the top of the hierarchy, giving weight to the inside money that banks spun from loans and ledgers. Trade boomed, factories roared, and the dollar's promise circled the globe. But credit grew faster than gold could follow, and the math began to strain. In 1971, the United States closed the gold window. No more turning dollars into gold at a fixed price. We entered the fiat era, money by decree, held together by law, habit, and belief. In this world, most money is born with a signature, not a stamp. A bank approves your loan, and in the same breath, it conjures a matching deposit into existence. Your mortgage, your company's credit line, your city's bond, they appear as numbers that others can spend. The smelter retired. The spreadsheet took the throne. The 1980s blew the doors open. Deregulation spurred competition, new products, and a race for yield. Savings and loan institutions reached further and risked more, soothed by the blanket of deposit insurance and the idea that depositors would stay calm. Then interest rates climbed, bad bets soured, and hundreds of S&Ls collapsed. Taxpayers paid a heavy bill, and a phrase gained weight: moral hazard, the risk that safety nets invite reckless acrobatics. The 1990s and 2000s layered on new complexity, the shadow banking system. Money-like promises slipped beyond traditional deposits into the world of repos, asset-backed commercial paper, and prime money market funds. The near collapse of long-term capital management in 1998 showed how tightly those promises were knotted. A private rescue kept the system from unraveling. A decade later, U.S. housing cracked that lattice wide open. The run of 2008 didn't snake around Main Street branches. It raced through the hidden pipes of wholesale funding. Policymakers answered with speed and scale rarely seen. Central banks cut rates to the floor, guaranteed critical liabilities, bought mountains of bonds, and in the US, the Treasury injected capital into shaky banks. Ordinary depositors didn't lose insured funds. In practice, even many uninsured depositors at the most vital institutions were spared because letting them fall threatened the entire edifice. Too big to fail hardened from a bitter slogan into a working rule. The system learned that, when breaking meant ruin, it would be held together at almost any cost. That realization demanded a rewrite. Dodd-Frank in the United States and new global Basel rules raised capital and liquidity buffers, forced giant banks to draft living wills, and mapped what would happen in a worse day. Resolution regimes introduced the bail-in, a method to burn shareholders and certain creditors to recapitalize a failing bank without calling on taxpayers. Long-term bonds issued by holding companies became fuses that could be lit in a crisis. In Europe, the Bank Recovery and Resolution Directive drew the line of who takes losses and in what order before public money steps in. Then, in 2013, Cyprus made the abstract personal. 2 major banks buckled under years of risky exposure. To reopen the doors, uninsured depositors, those above the protection limit, were bailed in, taking steep haircuts so the banks could stand again. Capital controls shaped everyday life. Limits at ATMs, transfers delayed, plans paused. Greece followed with withdrawal caps. Argentina's 2001 Corralito had already shown the pain of locked accounts. Lebanon's crisis after 2019 trapped savings that once felt certain. Different causes, same lesson. Access to your money depends on the machinery behind the counter. The pandemic shoved that machinery into warp speed. Governments sent relief at historic scale. Central banks unleashed oceans of liquidity. Deposits ballooned as households and businesses hoarded safety, and bank reserves swelled like storm clouds. In parts of Europe and Japan, interest rates dipped below zero. Some institutions quietly charged the largest depositors for parking cash. The message was clear beneath the polite language. Money is not only a store of value, it's a lever that policymakers can pull. By 2023, the first true smartphone-era bank runs arrived. Silicon Valley Bank held a deposit base heavy with large, uninsured balances, a field of dry grass in a season of sparks. Rumors moved at the speed of a group chat, and tens of billions fled in hours, not days. Regulators invoked a systemic risk exception to protect all depositors and rolled out emergency lending to stop the panic from spreading. Signature and First Republic followed into resolution. Across the Atlantic, Credit Suisse was ushered into the arms of UBS, with a shock wipeout of certain bondholders along the way. Technology compressed time, and confidence now lived or died at wireless speed. So what exactly makes your bank account not really yours? In legal terms, your deposit is a loan to your bank. The bank owns the money and owes you until it can't pay. If it fails, you stand in a line defined by law, policy, and urgency. Deposit insurance, up to $250,000 in the United States, $100,000 in much of Europe, acts like a shield. But beyond that, outcomes depend on resolution playbooks, deposit preference rules, and the judgment call of regulators in the fog of crisis. Beneath the daily calm lies a hierarchy. At the top sits central bank money, paper notes in your pocket, and reserves flickering across central bank screens. Just below are bank deposits, promises the bank will turn into cash on demand, couriers for your paycheck and your rent. Further down are money-like claims in the shadows, fund shares, repos, short-term IOUs that feel like cash until fear makes them heavy and slow. In good times, you live comfortably in the middle, treating bank credit as if it were cash. In a run, everyone tries to sprint up the hierarchy at once, and the staircase narrows. This architecture has consequences we all live with. It channels dormant savings into living investment, turning ideas into factories and code into companies. It keeps payments smooth and commerce quick, letting a million trades happen invisibly every second. But it concentrates power, making a few mega institutions pillars that cannot easily fall. It blurs public and private, because when promises tremble, the state is pulled onto the stage. And when rescues buoy asset prices, those who already own assets often rise first and highest. The blueprint keeps evolving because the waves keep coming. Money market funds, once treated as cash in a nicer suit, broke the buck in 2008 and faced runs again in 2020, prompting new rules on liquidity, fees, and gates. Stablecoins offer programmable dollars, but their sturdiness depends on reserves, risk management, and the honesty of their issuers. Some pegs have snapped the moment trust wavered. Central banks now explore digital currencies that would let you hold risk-free money directly with the state, a shift with deep consequences for bank funding and the speed of panics. Banks experiment with deposit tokens, digitized bank money riding new rails. Every innovation answers one fear and awakens another. Who do you trust to hold your promise? And what about you, the person with a paycheck, a card, and a thumbprint to unlock it all? Knowing the blueprint isn't an invitation to panic, it's a way to see clearly. You're not holding a sack of bills at your branch. You're holding a claim on a bank that holds claims on others, upheld by a government that manages cycles and crises. Deposit insurance protects small balances. Above that line, politics and policy can enter the conversation. Your money story includes characters you'll never meet. For policymakers, the craft is balance. If protections are too thin, trust can evaporate in an afternoon. If they're too thick, risk can swell quietly in the shadows, the bill arriving on some future night. Encourage competition and services improve. Allow consolidation to gallop, and too big to fail becomes a permanent address. In the end, someone must hold the risk. Banks, investors, depositors, taxpayers, and each choice writes the next chapter of this system's history. For bankers, deposits are borrowed trust. Capital and liquidity are not boxes to tick. They are the breathing room a bank has when a rumor goes viral. Clarity matters. When people understand what you do and how you can withstand a storm, they hesitate before they run. Culture matters too. Humility in a boom is the best defense against the arrogance that precedes a fall. When your raw material is confidence, stewardship is your first job. For the rest of us, the lesson loops back to something simple and human. Money is a social technology. It's a ledger and a story. And it works because we agree to believe. Trust should be verified, not assumed, and institutions should earn it, not inherit it. Each time the blueprint fails, we redraw it. Law by law, policy by policy, innovation by innovation. Our system is not a monument in stone. It's a bridge we are always tightening. Look again at the number on your screen. It mirrors a system that stretches from your living room to a central bank vault, from your neighborhood coffee shop to the arteries of global markets. Most days, those promises are as good as gold and the machine hums. Some days, they're not, and you can feel the gears catch. Seeing the difference before it matters is the line between surprise and preparedness. So, is your bank account yours? In everyday life? Yes, fast, familiar, ready when you need it. In the architecture of modern money, it's a claim you hold and a vote of confidence you cast in institutions that have broken before and will be tested again. That isn't a threat. It's an invitation to understand the world you already live in. When you know the blueprint, you can spot the fault lines and the foundations beneath your feet. In the end, money isn't a thing we own. It's a trust we extend.